This is Professor Hazara again. I'm just going to finish the example that we have done in the first two videos of Module 4, which is consolidation subsequent to the date of acquisition. Okay, so I'm just going to go ahead and quickly review what we've done and then finish consolidation. Okay, so what we're going to do now is I'm going to do the working paper, the consolidation entries, and consolidation entries. I'm going to put here, these are working paper entries. And the reason I say they're working paper entries is because they're done on a, they don't affect the accounting system or the parent or the sub. And so you take what comes out of those two separate accounting systems, put the statements together, do these entries on a working paper, and then combine the two statements. But these are sort of artificial entries. They're entries that are done temporarily on a working paper, which produce what you give to investors at the same time that will impact either the separate systems or statements of the parent or the sub. Okay, now here's the way these are going to work, these consolidation entries. We had done all these calculations up here for the equity method, and we had done our 3 equity method journal entries, which are really quite easy, come to a T account balance of 263.75. And then we had taken the parent's financial statements before the equity method and come to the entries after the equity method. And it's the statements after the equity method. Those are the statements that I have moved over here. Notice that big equity method items are the income from sub and the investment account. It was originally 0 here, came to 263.75 over here. So these statements after the equity method are the same as these over here. And so I'm going to take the post-equity method entries at the end of the year for the parent, combine those with the entries for the sub, and then we will see, we'll get some statements here. And I've got the equity method entries here. Notice that I have, there's 4 equity method entries. Number 4 is important, but not that important. The first 3 are the most important entries, and I'll show you why now. So if you go up to the equity method entries, we're going to have, let's call this one, this is going to be number 1. This is number 2. This is number 3. And this one is number 4. Now the first 3, I call them the big 3. These are the ones, these are 3 that are essential. They're absolutely essential to any consolidation. And these 3 entries, especially the first 2, are based on the calculations that we did up here. And the key calculation is going to be this reconciliation of the investment account. Notice that reconciliation equals the post-equity T account balances. And notice that after we did the equity method, the 263.75 is also the balance on your balance sheet that we'll use as the basis for the equity method, for the consolidation. Okay, so here's what we're going to do. We're going to take the 2 equity method accounts, which are income from sub. I'll put them over here. Income from sub. Take the 2 equity method accounts, and we're going to eliminate them. So we're going to eliminate that 21.25 equity method income from sub, and we're going to eliminate the equity method investment in sell, and then we're going to record some expenses that we've had. We got to expense the cost of goods sold for inventory, the excess cost of goods sold. We've got to record the excess cost of goods sold for equipment, and you notice that patent right now is recorded at 0, but we will take care of that through the entries, and we've got to record our amortization of the patent. Okay, so here's the way this is going to work. We're going to work backwards through the equity method analysis here. In the first entry, notice the purpose of entry number 1 is to reverse investment to its to its beginning balance. So what we're going to do is, this is why we do this analysis in this style, because what we're going to do is, what we mean by that is we're going to reverse, its current balance at the end of the year is 263.75. So the purpose of the first entry is going to be to reverse, take out the net income and dividends, and that'll take it from 263.75 to 262.5, which was its beginning of year balance. So we start by taking the investment account and taking the net income and dividends out, and with that, we will take out we'll reduce the investment to its beginning year balance. Now notice what the purpose of the second entry is. The purpose of entry number 2 is to eliminate the beginning balance. So, and we know the items in the beginning balance were these 5 common stock retained earnings and 3 write-ups. So the next thing we're going to do is we're going to take out the beginning investment balance. So we're going to make both the income account through the first entry and the investment account through both entries. We're going to reduce those to 0. Basically reduce the equity method to 0 and replace these 2 lines with the actual income statement in the case of income, the actual balance sheet in the case of investment, with the actual income statement, with the actual balance sheet. Let's go ahead and do that, and then we'll do the entry number 3 is to record current year's expenses. Look at that in a second. Okay, so income from sub, we're going to go ahead, make sure we'll put them in the same column. First thing to do is we're going to debit income from sub, and we're just actually going to go to do this. We're going to do this. We're going to debit income from sub to 21.25, and we're going to credit dividends. We're going to make that a negative to make it a positive. So I'll just go ahead and make that a negative so it's positive. We're going to credit dividends for 20, and we take the difference. The difference is the plug, and it goes into the investment account. We're going to reduce the investment account by 1.25. And notice when we get to the consolidation, that 1.25 reduced the investment account from 263.75 to 262.5. Now, in the next entry, we're going to take, and this is the important calculation. That's why this reconciliation is so important. We're going to take these 5 amounts, we're going to debit those against the beginning investment balance of 262.5. Okay, so the first thing we're going to do is we're going to actually eliminate the subsidiary's common stock, because we're pretending that the subsidiary, you own it and control it, and instead of saying it doesn't exist, in a sense, in a sort of theoretical sense. So we're going to debit retained earnings for 50. So we're wiping those off, and we're going to make those 0, and we're going to make that part of the investment account 0. Now the investment account also includes debits, write-ups, 3 asset accounts. To inventory for 12.5, to equipment 25, and to patent for patent 25. Okay, so the investment, this should sum to the beginning investment balance, the sum of these things. I'm just checking myself here. 262.5. So when we credit investment for 262.5, we will have an investment balance of 0. We took out 1.25 here, whatever it is. 1.5 or 1. Whatever, and then that reduced to 262.5, which is the beginning balance. And then we just took out, have credit the beginning balance and debit these 4 items. 2 is we're eliminating the subsidiary's common stock and retained earnings, and finally we're writing up 3 assets. Okay, the third entry is to record. I'm going to say to record current year expenses. Current year expenses. And what we've got to do is, at the beginning of the year, nothing had been expensed because no time, the inventory had not been sold, and no time had gone by to record depreciation or amortization. Okay, however, now time has gone by, and we've got to start writing down our assets by their write-down amounts. So we know we can actually take these amounts off of the equipment, off of the net income calculation. We're going to write inventory down by 12.5, equipment down by 5, and unrecorded patents down by 1.25. I'm going to make those negative amounts because the credit Okay, so here we go. Inventory, we're going to credit for 12.5. Equipment, we're going to credit 25. And patent, we're going to credit by, I think, a small amount, 1.25. I got to make that a negative. Make that a negative here. Okay, and so we're writing these assets down and expensing them. Now, the credit to inventory is really cost of goods sold. It's excess cost of goods sold. And the credits to equipment and patent are basically depreciation or amortization expense. I'll put those into I don't get that, but that's okay. Okay, so 12.5 is our excess cost of goods sold. That's what we wrote down inventory by because it was sold, and then we depreciate. We're going to depreciate. Wait a minute here. I got to make sure this is the right number. We're going to depreciate 5. The wrong calculation. I think the equipment is going to be depreciated by 5, and I got that from the income calculation. Okay, so the depreciation expense is going to be 12.5. It's going to be equal to 5, which is depreciation on the equipment, plus the amortization on the patent. So our expense there is going to be 60.265. Now, just to finish this off, it is important in real life, but for logical person, not important. You'll get this in a lot of the problems that one company owes the other one money. Now, from a consolidated perspective, which is their one company, you can't owe yourself money. If a company can't lend itself money. And the perspective here is that they owe each other money, but you can't owe yourself money if you're looking at them as one company. This is what we're doing. So we'll just debit accounts payable for 4, and we'll credit accounts receivable for 4, which means you're reducing money they owe each other. In real life, you can't owe each other money. Okay, so let's go ahead, and this is going to be very important. Where do we place the various amounts to these entries? And I'll go through this slowly, as slow as I can, given my never-ending problem with this space, but I think we can do this. Okay, so, already came out. I'm going to go ahead and erase these, and we will see what we get there. First thing I'm going to do is I'm going to go ahead and I'm going to sum these numbers to make sure that everything is adding up. So we will add up starting here, going down there, and just go ahead and copy this over. There, 2.5. Oh, what am I doing? I'll just do it again. Credit for 4. Wrong line. So it's equal to the sum of all the entries. It's going to turn out correctly. You could maybe see. Add up this. These are the addition of my consolidation entries. 6.5, and we'll come over here and copy this over here to make sure these add. So our entry should be equal to 306.5. The first entry we're going to put in is entry number 1. We're going to debit income from sub, credit dividends, and credit the investment account. Okay, so the debit to income from sub, it's from entry 1, and that is going to be, might as well post it. Might as well go ahead and post all these. 21.25. Then the credit to dividends. Now, you'll see that the credit to dividends is going to be on the statement of retained earnings, and it's from entry number 1, and we're going to credit dividends. Keep going up too high. For 20, and we're going to Okay, that looks okay. And the difference is gonna be credited to the investment account, which is this entry right here. And go up and actually post the entry so you can see that credit goes to the investment account. Okay, so that takes care of entry number 1. And I want to see if I have a total here. I want to go ahead and put a sum here of these amounts. So as I go through this, I know that they're coming out. Okay, now we go on to entry number 2, which is always the longest. So we're going to debit the beginning balances, common stock and retained earnings, and debit inventory, equipment, and patent for these amounts right here. So there's one thing you have to be very careful with, and I want to really emphasize this. So we go down to common stock, entry number 2. We debit common stock for $150. Now the retained earnings are the beginning retained earnings. We assume we haven't sold. We're going to make the assumption we don't sell stock or buy back treasury stock. So we're always going to assume the common stock doesn't change. But the retained earnings were the debit to retained earnings. These are your beginning retained earnings. So what we're going to do is we're going to debit the beginning retained earnings to eliminate the beginning retained earnings, which, by the way, is that 50 right there. We're going to eliminate that. Now we're going to debit the 3 assets to write those up. Inventory, these entries 2, entry 2. So we're going to debit inventory for 12.5. We're going to debit equipment for 25, I believe. And we're actually going to record that patent. We're going to record the patent for 25. And then we're going to go ahead, and the final credit here is we're going to credit the investment account for its beginning balance of 262.5, which makes it 0. Okay, I don't know why I put a line in here or why this, but you'll notice that for the investment account, we started at 263.75, we got 1.25, which was the change from one year to the other, and then we took out the beginning balance. So our ending investment account is 0, which should always be the case. We'll get to that at the end. Okay, and let's see if our entries are balancing. It does look like our entries are balancing. So what we've done so far is the investment account is 0, and the income from sub, if I get lucky, is also 0. So we've eliminated our equity method balances. Those are as of the beginning of the year. Now we've got to actually record the current year's expensing because we're going to have some excess cost of goods sold for the inventory, and that's entry number 3. And the depreciation for amounts here. So we're dealing in entry number 3 here. Debit cost of goods sold for the inventory write-up, depreciation expense for equipment and patent write-up. So in entry number 3, debit cost of goods sold for 12.5. We're going to debit depreciation expense for whatever 6 point, whatever it is, 6.25, and then we've got to write down the assets because we're writing the assets down by the amount of those excess expenses. So, because we recorded the assets at fair market value, we wrote them up. Now we've got to write them down. Inventory is 12.5. our equipment, we're going to take 25. No, we're going to take 5 out of the equipment. That's a long-term asset. We're going to have 20 left, which is another 4 years. And for this patent down here, we're going to take out 1.25 for the patent. That's just a coincidence that 1.25 for the patent and investment are the same. It's just pure coincidence. Okay. Next, we will credit. We'll finally finish with entry 4, which was just eliminating a reciprocal account receivable, account payable. So we're going to reduce our accounts payable. That should be a debit to accounts payable of 4. And a credit to accounts receivable of 4. That should finish our consolidation. Now let's see if it balances. And I think I'm going to go ahead. And it does balance. Total assets, 729.5. And total equity and liabilities, 729.5 also. I'm going to go ahead and erase these numbers here and take about 5 or 10 more minutes just to show you how I got those. It did balance though, so it should turn out to be okay. Okay, so sales is going to be 200 plus 110, just to get in the habit, plus any credits, which are 0, but soon they won't be, minus any debits, which is going to give you the 310. Income from sub is just going to be 21.5 plus whatever's on the subs book, which is never the case, plus the credits minus the debits, which should give you a balance of 0. And this should always be 0. Okay, the cost of goods sold is going to be negative 80 plus, I'm getting this right, negative 40 minus a positive 12.5. That should give us 132.5, and that's correct because that debit of 12.5 increases cost of goods sold. We can just copy this same formula for that expense down to these other 2 expenses. That looks correct, and that looks correct. And then finally, our net income we're going to calculate is going to be equal to 310 plus all these numbers here, knowing that some are negative. And we get 75.75. Now, I want you to notice something, and this should always be the case. If it's not, you're going to get points off. That on a consolidated income statement, the parent's net income is always equal to the consolidated income, or vice versa. These two should check. Those two should always be equal. Okay, what we're going to do now is, once you finish one statement, you work down to the next. The net income that we bring down to the statement of retained earnings, it's like closing net income to retained earnings. We bring that down. I could put arrow going down. That's okay. Okay, now we start with beginning retained earnings. Now, the beginning retained earnings are the parents plus the subs minus the write-off we did. So 75. So notice the parents' retained earnings, beginning retained earnings are the same, net income. Then we do the subtotal, which is equal to the parents again. So it seems to me like the consolidated statements are like the parents. That will be true for the income statement, the statement of return earnings, but not the balance sheet. Okay, then our dividends are going to be the parent plus the sub minus the sub. I should put plus that, I guess. Negative 40, which is the same with the parents. So your ending retained earnings are going to be that subtotal minus the dividends. So notice once again, the parents' ending retained earnings are the same. These statements are exactly the same. You compare parent consolidated statement of earnings, exactly the same. And then what we do with the ending retained earnings is you got to bring the ending retained earnings down here. That doesn't always equal, but that's okay. Well, that should be okay. And then we'll just go ahead and figure out the rest of these. Cash is the parent plus the sub. The accounts receivable are the parent plus the sub. Might as well put an equation plus any debits minus any credits. That gives you 64. I can copy this formula down to all these assets. Do up to the investment account. It gives you dividend receivable of 8. May want to write that off. That's okay. This is 70. Notice you wrote inventories up, then you sold them all. So you wrote them down. 70. Okay, the land stays the same. 15 plus 30. The buildings is 135. The equipment should be 300 plus 20 because that nets up to 20. 320. The investment account, now let's be careful with this one because I put a line, I don't know I did, is going to be 263, and I'll just do this quickly, minus 125, which is the change in balance, minus the beginning balance. That is equal to 0, and it should be. Okay, so our total assets here, let's not forget the patent. Patent is 25 minus the 1.25. That gives you 23, that's 19 years left of unamortized patent, which times 1.25. Okay, so we're going to go ahead and sum these up. Let's see what our sum came to. 665.75. Hopefully that is a sum. Okay, our accounts payable is not parent plus 50 minus the debits plus any credits we might have. Okay, so we can just go ahead and copy this down to dividends payable, other liabilities, and I believe even common stock. So that other dividends payable looks good. The other liabilities look good. Common stock is equal to the parents. That looks good. Let's see what we end up with here. 729.5. Didn't these total up? Just going to review this. 0 minus. Those equal there. $12.21. Oh, I left R1. I left cash out of here. Too quick on this one. Yep. I left the cash out of there. 729.5. So we're perfect. Our balance, we balance out. But just to recall a couple of things is number one is that the net income should always equal, parents' net income should always be equal to the consolidated income. Same thing for ending retained earnings. The one statement which that won't be true for is the balance sheet. The balance sheet always changes, but the balance sheet should balance, and it balances 729.5. The other point of importance is that when you consolidate, what you're doing, and for the income, let's say, you're taking the equity method income from sub, which is 21.25, making that 0, but then replacing it with the actual income items. And those actual income items, they total to 40, but you notice that you've taken out these expenses, so that makes it a little smaller. But basically, you're taking that number right there, make it 0, and replacing it with all the adjusted amounts here. Retained earnings, basically the same idea. The balance sheet, what you're doing is taking the investment account, making it 0, and replacing it with all these items, with the actual balance sheet items. Okay, and this is the one statement which won't where the parents balances won't be equal to. So for net income, for the income statement, the parent's income should always equal the balance, consolidated statement balance. Same holds true for retained earnings, but not necessarily for the balance. So anyway, I'll go put this video up and we'll go from there. Happy accounting.